You swipe a piece of plastic. You get food, clothes, flights, random Amazon junk you forgot you ordered. No cash leaves your hand. No pain, just vibes. Then, a month later, you owe money. Not just the money you spent, more. That more is the entire business model. Credit cards aren't evil, they're tools, but they are designed by banks, and banks do not build billion-dollar systems out of kindness. Today, we're breaking down how credit cards actually make money: interest, fees, merchants, behavior, and why the most responsible customers are sometimes the most profitable. Running example for today, your late-night wing addiction, because nothing explains finance better than chicken you didn't need. Let's go.
The basic deal. A credit card is a short-term loan. That's it. When you swipe, the bank pays the restaurant. You now owe the bank. If you pay the full balance by the due date, you usually avoid interest. If you don't, the meter starts running. So the card company makes money in two main ways: from you, from the business you bought from. We'll break both down. Okay, first up, interest. Interest is the price of borrowing money. If your card has a high annual percentage rate, APR, that's the yearly cost of carrying a balance. Most credit cards have relatively high interest rates compared to things like mortgages. Important, APR is yearly, but interest is typically calculated daily. So when you carry a balance, you're paying a small amount every single day you don't pay it off. Let's use the wing example. You order $200 worth of wings over a month. You don't pay it off. Now that $200 starts growing. Not like investing, the opposite. And because credit card interest compounds, you can end up paying interest on previous interest if you keep rolling balances. So what? So that minimum payment? Banks are not your friend. They keep you in the system longer. Moving on. Minimum payments. That tiny minimum due number looks nice. Maybe it's $25. Feels manageable. Here's the trick. Minimum payments are designed to keep you paying mostly interest at first. The bank wants you current, not free. If you only pay the minimum on a growing balance, repayment can take years, and the total interest paid can be huge compared to the original purchase. Your $200 wing phase can quietly turn into $260, $300, more, depending on how long you stretch it, and you'll barely remember the taste. Cool. Now here's the other side. Merchant fees. Even if you pay your balance in full every month, no interest, the bank can still make money. How? From the restaurant. When you swipe your card, the business pays a transaction fee. This is often a small percentage of the sale plus a fixed amount. So your $40 wing order, the restaurant might lose a small cut of that to the payment network and the issuing bank. Why would businesses agree to that? Because cards increase spending. People spend more when they don't feel cash leaving their hands. Which brings us to psychology. Spending behavior. There's solid behavioral research showing people often spend more when using credit instead of cash. It's called reduced pain of paying. When you hand over physical cash, it feels real. When you tap plastic, it feels delayed. So instead of ordering 10 wings, you order 20 because future you can deal with it. Credit cards expand your short-term purchasing power, which is great until it isn't. Banks know this. More spending equals more transaction fees. More balances equals more interest. Okay, but there's more. Annual fees. Some cards charge annual fees. Why would anyone pay to have a credit card? Rewards. Travel points, cashback, airport lounge access, fancy metal cards you slap on the table. Premium cards make money in two ways: annual fee revenue, hoping you either overspend or carry a balance. If you maximize rewards and never pay interest, you can come out ahead. But most people don't optimize perfectly, and rewards programs are structured so that heavy spenders generate more swipe fees for the bank, which leads to rewards math. Cashback sounds free. 2% back on everything. Nice. But remember, the merchant paid a fee on that transaction. Part of that fee funds your reward. If you spend $1,000, you might get $20 back. Cool. But if you spend $1,300 because points, that extra $300 wipes out your reward. Rewards only make sense if you already planned the purchase. You pay in full. You don't increase spending because of them. Otherwise, your free flight was just expensive chicken in disguise. Okay, next. Late fees. Miss a payment? Late fee. Interest may increase, and your credit score can take a hit. That hit matters because your credit score affects your ability to borrow money in the future for cars, apartments, maybe a house. Credit cards make money from mistakes. Late payments, over-limit fees, less common now but historically big, penalty rates. The system rewards discipline. It charges for chaos. Moving on.
Revolvers versus transactors. In the credit card world, customers fall into two broad categories. Revolvers carry balances month to month, pay interest. Transactors pay full balance every month, no interest. Guess who makes more money for banks? Revolvers. But here's the twist. Transactors still matter. They generate swipe fees. They keep the system active. They make the network bigger. And sometimes, transactors become revolvers during tough months. Life happens. Car repair, medical bill, job shift. And suddenly, those wings are the least of your problems. Okay, big picture time.
Risk and default. Banks know some people won't pay at all. That's called default. So they price cards with high interest rates, partly to compensate for that risk. Higher risk borrowers typically get higher interest rates. This isn't personal, it's math. The bank is betting that across millions of users, enough people will pay interest, enough merchants will pay fees, defaults won't exceed projections. That spread is profit. Cool. Now let's talk credit scores.
Credit scores. Using a credit card responsibly can help build credit history. Credit scores are influenced by several factors, including payment history, credit utilization, how much of your limit you use, length of credit history, types of credit, new credit inquiries. One big factor, utilization. If you have a $1,000 limit and consistently use 900 of it, that's high utilization. It can hurt your score, even if you pay on time. So your wing spree using 90% of your limit? Not ideal. Keeping balances low relative to limits is generally better for scores, so the card can help you, if you control it. Next layer. Why credit cards exist? Credit cards solve real problems. They offer fraud protection, provide short-term liquidity, allow online transactions, create a record of spending. They are safer than carrying large amounts of cash, and many offer dispute protections. So this isn't credit cards bad, it's credit cards are powerful, and powerful tools amplify behavior. Disciplined person, free rewards and credit history. Undisciplined person, high interest debt spiral. The plastic doesn't decide. You do. Almost done.
The real business model. Let's zoom out. The credit card ecosystem includes the issuing bank, the payment network, the merchant, you. Money flows every time you swipe. Even if you're perfect, the system earns from merchants. If you slip, interest. If you forget, fees. If you overspend, higher balances. Your late-night wing habit is not just a craving, it's revenue. And multiplied across millions of people? Massive. Okay, rapid recap.
Credit cards are short-term loans. Interest is the cost of borrowing. APR is yearly, but interest accrues daily. Minimum payments keep you in debt longer. Merchants pay swipe fees. Rewards are funded by spending. Late fees punish mistakes. High utilization can hurt your score. Banks price for risk. Revolvers generate most interest income. Transactors still generate fees. Behavior drives profit. Final, so what? Use the card. Don't let it use you. If you're going to buy wings, fine. Just don't finance them for 2 years. And if this explained credit cards better than your high school ever did, like the video, subscribe, and maybe comment your worst "I'll just pay it next month" purchase. I'm guessing it wasn't broccoli.